Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or buy rating on my 33-question research checklist. In this special episode of the podcast, we'll explore a beginner's guide to getting started with investing. Starting your investing journey, regardless of your age, can set you on a path to financial success. While youth does offer the unique advantage of time, allowing for compounding growth, it's never too late to begin. We'll discuss essential topics that can help you build a strong foundation, no matter where you are in life. Whether you're a fresh graduate or someone considering investing later in life, join us as we uncover the key strategies and insights that will empower you to take control of your financial future. I first will discuss some key concepts to investing, risk and return. So this is the relationship between the potential risk of an investment and the expected rewards. Generally, higher risk investments offer the potential for higher returns. Equity risk premium. This is the extra return that investors expect to earn by investing in stocks rather than risk-free assets like the 10-year treasury bonds. Compound interest. This is interest calculated on both the principal and previously accumulated interest. It's a powerful concept that can significantly accelerate wealth growth over time, especially with long investment horizons. The rule of 72 is a quick way to estimate how long it will take for an investment to double. You divide 72 by the annual return rate to get the approximate number of years needed to double your money. CAGR, or compound annual growth rate. This is a mean annual growth rate of an investment over a specific time period longer than 1 year. It provides a smoothed annual rate that eliminates fluctuations in periodic returns, making it easier to compare investments over time. Asset allocation. This is the strategy of dividing investments among different asset categories such as stocks, bonds, and real estate to manage risk and achieve specific financial goals. Risk tolerance. This is an important one, and it's an investor's ability and willingness to endure market volatility and potential losses. Understanding your risk tolerance is crucial for determining an appropriate asset allocation strategy. Diversification. This is spreading investments across various asset classes, stocks, bonds, or real estate as some examples, to reduce risk. By diversifying, investors can mitigate the impact of poor performance in a single investment. Beta. Beta measures a stock's volatility in relation to the overall market. A beta of 1 indicates the stock moves with the market. Less than 1 suggests lower volatility than the market, and greater than 1 indicates higher volatility. Beta helps investors understand the potential risk and return characteristics of a stock. One other interesting thing about beta is that there is research showing that lower beta actually meets or slightly beats market returns, and that higher beta does perform worse than lower beta. So this is an area that I would encourage listeners to explore more. Liquidity. Liquidity refers to how easily an asset can be converted into cash without significantly affecting its price. Highly liquid assets like stocks can usually be quickly sold, while illiquid assets like real estate may take longer to sell. Market capitalization. Market capitalization is the total market value of a company's outstanding shares, and they're usually categorized as mega cap, large cap, mid cap, or small cap. This classification indicates their size and stability. From market cap, there's enterprise value, or EV. This is a comprehensive measure of a company's total value, including its market cap, its total debt, and its total cash. It's often a more accurate representation of a firm's value than market capitalization alone, especially in mergers and acquisitions. Dollar cost averaging. DCA, or dollar cost averaging, is investing a fixed amount regularly, regardless of market conditions, to reduce the impact of market volatility. Price to earnings, or PE ratio. The PE ratio is a valuation metric that compares a company's stock price to its earnings per share. A higher PE suggests investors expect higher earnings growth in the future, while a lower PE might indicate a company is undervalued or has lower growth prospects. Dividend yield. While I am not a dividend investor, this is an important key concept to know. Dividend yield is the annual dividend payment expressed as a percentage of the stock's current price. It's calculated by dividing the annual dividend per share by the stock's price per share. A higher dividend yield can be attractive for income-focused investors, but it's important to consider the sustainability of the dividend. Ex-dividend date, the date on which a stock begins trading without the value of its next dividend payment. Investors must own the stock before this ex-dividend date to receive the upcoming dividend. After this date, the stock price typically drops by approximately the amount of the dividend. Capital gains. Capital gains are the profit realized from the sale of an asset when its selling price exceeds its purchase price. Capital gains can be classified as short-term, which are held for 1 year or less, or long-term, held for more than 1 year, with long-term capital gains typically taxed at a lower rate. Tax loss harvesting. This is a strategy used to offset capital gains taxes by selling losing investments to realize losses. These losses can be used to offset taxable gains from other investments or reduce taxable income up to a certain limit. The last key concept is expense ratio. This is the annual fee expressed as a percentage of a fund's average assets under management, covering operational expenses such as management fees and administrative costs. They apply to ETFs, mutual funds, and index funds. Typically, lower expense ratios are better, and expense ratios can significantly impact long-term investment returns. The next area I'd like to discuss is investment types. There are 3 primary asset classes and then 3 other asset classes that I'll discuss. The first primary asset class is stocks or equities. This is ownership shares in companies. There's also bonds or fixed income. These are debt securities issued by governments or corporations. And third, cash and cash equivalents. This is highly liquid, low-risk investments such as money market funds, certificates of deposit, or savings accounts. And then there's a couple other asset classes. Real estate. This is physical properties or REITs, which are real estate investment trust. There's also commodities, which are physical goods like gold, oil, or agricultural products. And then managed futures, which is a category of alternative investments that utilize futures contracts across various asset classes, including commodities, currencies, stock indices, and fixed income. And these strategies often incorporate trend following methodologies, which allows for investors to capitalize on price movements in both rising and falling markets. Managed futures, especially in an ETF wrapper, offer several advantages. One is diversification. They provide exposure to multiple asset classes and can potentially lower overall portfolio risk. And then non-correlation. Managed futures often have low correlation with traditional stocks and bonds, potentially improving portfolio performance during market downturns. However, it is important to note that managed futures can be complex and may involve higher fees, such as 90 to 100 basis points. One other one is cryptocurrencies. This is digital or virtual currencies. It's not something that I'm too involved with. The next section, investment vehicles. I'll talk a little bit about mutual funds, index funds, ETFs, and individual securities. For mutual funds, this is pooling capital from multiple investors to create a diversified portfolio of assets. They are actively managed by professionals who make investment decisions based on research and market analysis. For index funds, this is a specific type of mutual fund designed to passively track the performance of a particular market index, such as the S&P 500. Index funds typically have lower fees than actively managed mutual funds due to their passive management style. For ETFs or exchange-traded funds, these are similar to index funds, where ETFs hold a diversified portfolio of assets, but they trade in stock exchanges like individual stocks. ETFs have gained popularity over time due to their flexibility, lower expense ratios, and tax efficiency. And then individual securities, these are individual stocks or bonds. For stocks, these are shares representing ownership in a single company, and investing in individual stocks allows for targeted exposure to specific companies. Bonds are just debt securities issued by corporations or governments that pay interest over time. Investing in individual bonds can provide steady income and some diversification benefits. I'd then like to talk about investment strategies. There's a couple different that I'll highlight here that I find interesting myself. The first one that most people are aware of, active versus passive investing. Active investing is a strategy where investors or fund managers actively buy and sell securities with the aim of outperforming the market benchmarks. This approach requires in-depth research and market analysis. Passive investing, however, is a strategy focused on replicating the performance of a specific market index through investments in index funds or ETFs. This approach involves minimal trading and lower fees, as investors typically hold securities for the long term, relying on the market's historical upward trajectory. There's also two market tracking strategies, which are index investing and factor investing. Index investing is a form of passive investing that aims to mirror the performance of a specific market index, such as the S&P 500. Factor investing is a strategy that involves selecting stocks based on specific characteristics or factors, such as size, value, momentum, or low volatility, to enhance returns. I've spent a lot of research in factor investing the last few years myself, and if there's anything to take away from this podcast episode, I would encourage investors to learn a little bit more about factor investing. The next strategy is growth-oriented strategies, and there's three that I'll talk about here. The first, buy and hold. This is a long-term investment strategy where investors purchase assets and hold them for an extended period, expecting appreciation over time. I then have growth investing, which focuses on investing in companies that are expected to grow at above average rates compared to industry peers and the market as a whole. I then have quality growth investing, which is targeting high quality companies that can sustain above average growth rates over the long term, which is usually a 10 to 50 year horizon. These companies typically reinvest capital effectively, generate significant free cash flow, maintain low debt levels, and are led by competent management teams. I then have a bucket for value investing, which involves identifying undervalued assets that are trading below their intrinsic value with the expectation that their prices will eventually rise to reflect true worth. There's then income-oriented strategies, which I have income investing and dividend growth investing. Income investing prioritizes investments that provide regular income through dividends or interest payments, and usually with a high dividend yield percentage. Dividend growth investing concentrates on companies with a strong history of consistently increasing their dividend payments over time, providing both income and potential capital appreciation. I then have one more strategy under tactical strategies, which is sector rotation or mean reversion. This is shifting investments between different economic sectors based on their expected performance in various phases of the economic cycle. So as one example, if energy did bad last year, they in theory should reverse to the mean at least some next year, and you would be sector rotating based on that information. I then wanted to discuss portfolio construction. First, asset allocation. So asset allocation is allocating investments among various asset classes, such as stocks, bonds, cash, real estate, commodities, and managed futures to achieve effective diversification. There's also domestic international allocation, and considering this percentage breakdown is crucial. While some recommend limiting foreign stocks to no more than 20% of an equity portfolio, foreign stocks represent about 50% of the global market capitalization. Investors focused on global market cap weightings might allocate approximately 60% to US, 30% to developed markets, and 10% to emerging markets. There's also a stock bond allocation decision to make. A conservative portfolio is around 40% stocks and 60% fixed income. A moderate portfolio is around 60% stocks and 40% fixed income. A moderately aggressive portfolio is 80% stocks, 20% fixed income, which only those in their 20s probably should be doing, if at all, is 100% stocks. There's then the decision of the number of stocks to have in your portfolio. For large cap portfolios, diversification benefits diminish significantly beyond around 15 stocks. And in contrast, small cap portfolios achieve peak diversification with 20 to 25 stocks. My personal portfolio has 20 stocks. Ideally, it would be great to have around 15, but I am comfortable with 20 right now. And research by Frank Riley and Keith Brown suggests that about 90% of the maximum benefit of diversification can be achieved with just 12 to 18 stocks. In terms of adding new assets to your portfolio, the more uncorrelated the better, so you can improve your risk-return profile. This is why I liked managed futures so much. Bonds are also good diversifiers with stocks. Some include gold in their portfolio, and I encourage listeners to do more research in this area as it can make up a small percentage of your portfolio as well. And this includes physical gold as well as some ETFs. For asset location, this is a key concept that's different than asset allocation in that it's placing investments in different account types, such as taxable, tax-deferred, and tax-exempt, to enhance after-tax returns. So the first thing you want to do is understand account types. Taxable accounts are subject to capital gains taxes on realized gains. Tax-deferred accounts are where taxes are deferred until withdrawal. An example of this is just regular IRA. Tax-exempt accounts is where there's no taxes on any withdrawals. And an example of this is a Roth IRA. The most tax-efficient assets are low-yield money market accounts, cash, and short-term bonds. Next are total stock market index funds and tax-managed stock funds. Moderately inefficient assets include total market bond funds. As I conclude this episode, I'd like to leave the listener with 10 tips to get started. First, define your financial goals. Start with a clear understanding of your financial objectives and risk tolerance to guide your investment decisions. Second, establish an emergency fund. Ensure you have a sufficient emergency fund to cover unexpected expenses before diving into investing. Third, start small and learn. Begin with a manageable investment amount to build your knowledge and confidence in the markets. Fourth, diversify your investments. Spread your investments across various asset classes, such as stocks, bonds, managed futures, and real estate, to reduce risk and enhance potential returns. Fifth, consider low-cost index funds or ETFs. For your core portfolio, opt for broadly diversified index funds or ETFs that offer low fees and exposure to various markets. Focus on long-term growth. Prioritize strategies that promote long-term capital appreciation rather than chasing short-term gains. Seventh, contribute regularly. Make consistent contributions to your investment accounts, utilizing dollar cost averaging to smooth out market volatility and lump sum investing in the case of bonuses. Eighth, be mindful of fees. Understand the fees associated with your investments, as high costs can significantly erode your returns. Ninth, practice patience and discipline. Stay committed to your investment strategy and avoid reacting impulsively to market fluctuations. And number 10, keep learning. Stay informed about financial concepts, market trends, and investment strategies to make better decisions over time. And that wraps up today's episode of Investing 101. I hope you found our exploration of key investing concepts, types, vehicles, strategies, and portfolio construction both insightful and actionable. Remember, investing is a journey and every step counts. If you enjoyed today's episode, please subscribe or leave a rating. Your feedback helps us improve. For real-time updates and insights, follow me on X at Invest091. Join me next on February 5th when I'll dive into Evolution Gaming, ticker symbol EVO or EVVTY. Until then, keep your investments smart.